If we take, for example, during the pandemic, the response of the political apparatus was to lower interest rates to zero, buying assets, in essence, printing money. And the defense was there's no inflation. But of course, you had one part of the economy where it was locked down, so it was illegal to buy anything, either illegal or it was impractical. So it would be impossible for demand to manifest. So of course, there is no inflation. There was instantaneous, immediate inflation in another part of the economy. You lowered the interest rates to zero. At one point, we saw the swap rate on a 30-year note go to 72 basis points. That means that the value of a long-dated bond immediately inflates. So the bond market had hyperinflation within minutes. The asset market had hyperinflation. We had what you call a K-shaped recovery. Main Street shut down. Wall Street recovered all within 6 weeks. The inflation was in the assets, like in the stocks, in the bonds. You know, if you look today, you see that typical house, according to the Case-Shiller Index today, is up 19.2% year over year. If you're a first-time home buyer, the inflation rate is 19%. The formal CPI announced at 7.9%. You can pretty much create any inflation rate you want by constructing a market basket, right? A weighted basket of products or services or assets that yield you the answer. You know, the fundamental failing of economists is first of all, they don't really have a term for asset inflation. They define a synthetic metric, right? I mean, I'm going to say you should have 1,000 square foot apartment and you should have a used car and you should eat, 3 hamburgers a week. Now, 10 years go by and the apartment costs more. I could adjust the market basket by they call them hedonic adjustments. I could decide that it used to be in 1970 you needed 1,000 square feet, but in the year 2020 you only need 700 square feet because we've miniaturized televisions and we've got more efficient electric appliances, and because things have collapsed into the iPhone, you just don't need as much space. Rather than embracing inflation based upon its fundamental idea, which is the rate at which the price of things go up, they've been captured by mainstream conventional thinking to immediately equate inflation to the government-issued CPI or government-issued PCE or government-issued PPI measure. Two big things. One thing is the government gets to create the market basket, and so they keep changing what's in the basket over time. If I said 3 years ago you should go see 10 concerts a year and the concert tickets now cost $200 each, now it's $2,000 a year to go see concerts. Now I'm in charge of calculating inflation, so I redefine, your entertainment quota for the year to be 8 Netflix streaming concerts, and now they don't cost $2,000, they cost nothing, and there is no inflation, but you don't get your concerts. During the crisis of March of 2020, the interest rate went on a 10-year bond went to 50 basis points. So now the cost of that bond is $10 million. Okay. The cost of Social Security went from $1 million to $10 million. So if you wanted to work your entire life, save money, and then retire risk-free and live happily ever after on a $50,000 salary, living on a beach in Mexico, wherever you wanted to go, you had hyperinflation. The cost of your aspiration increased by a factor of 10 over the course of, some amount of time. In fact, in that case, that was like over the course of about 12 years. What's the problem with the inflation rate in housing being 19%? It's an awful problem for a 22-year-old that's starting their first job, that's saving money to buy a house. But it would be characterized as a benefit to society by a conventional economist who would say, well, housing asset values are higher because of interest rate fluctuation, and now the economy's got more wealth. And so that's viewed as a benefit. A conventional view of inflation as CPI understates the human misery that's inflicted upon the working class and on mainstream companies by the political class. And so it's a massive shift of wealth from the working class to the propertied class. It's a massive shift of power from the free market to the centrally governed or the controlled market. It's a massive shift of power from the people to the government. There's nobody in government, no conventional economist that would ever admit to an inflation rate of 7% a year in the US dollar over the last century. If you look at the S&P index, which is a market basket of scarce desirable stocks, it returned about 10%. The money supply is expanding at 7% 100 years. If you actually talk to economists or you look at the economy and you ask the question, how fast does the economy grow in its entirety year over year? Generally about 2 to 3%. Like the sum total impact of all this technology and human ingenuity might get you a 2.5%, 3% improvement a year. If you had the human race doing stuff,
Yeah.
and if you ask the question, how much more efficiently will we do the stuff next year than this year? Or what's the value of all of our innovations and inventions and investments in the past 12 months? You'd be hard pressed to say we get 2% better. Typical investor thinks they're 10% better every year. So if you look at what's going on, really, when you're holding $1 million of stocks and you're getting a 10% gain a year, you really get a 7% expansion of the money supply. You're getting a 2 or 3% gain under best circumstances. If the money supply stopped expanding at 7% a year, the S&P yield might be 3% and not 10%. It probably should be. Now that gets you to start to ask a bunch of other fundamental questions, like, if I borrow $1 billion and pay 3% interest and the money supply expands at 7 to 10% a year, and I ended up making a 10% return on a $1 billion investment paying 3% interest, is that fair?